Here at Reuters Breaking Views, we spend a lot of time talking about private credit. This is the corner of finance where, in a nutshell, loans are made by funds rather than banks. For a while, these funds mostly lent to mid-market companies, the types of businesses which found it harder to tap bank credit after the 2008 financial crisis, because tighter regulation had prompted banks to retrench. But in recent years, private credit has expanded in multiple directions. These funds have lent to private equity firms providing financing for even very large leveraged buyouts. And they've also moved into asset-based finance, such as real estate, aircraft leasing, and so on. It's a changing industry and estimates vary, but private credit funds are probably now worth around $2 trillion in total. And they're growing very quickly. This growth raises all kinds of issues. Are these funds better or worse than banks at assessing the creditworthiness of borrowers? Is private credit structure, where long-term loans are matched by long-term funds, actually safer than banks, which tend to rely more on deposits and short-term financing? How is this shift in the industry affecting the business model of regular banks? And how big can private credit get? So this week on The Big View, we're going to delve into this fascinating part of the financial services industry. It's what we do at Reuters Breaking Views. We tap our best sources around the world to bring you fresh insights into the biggest questions in business, finance, and economics. I'm your host, Peter Thalassen. And to help us think through this topic, I've invited Hugh Van Steenis onto the show. Hugh is partner and vice chair at Oliver Wyman, the consultancy firm. Previously, he was senior advisor to the chief executive of UBS, and before that, senior advisor to the governor of the Bank of England, and before that, he was global head of banking research at Morgan Stanley, which is where I first got to know him. I've been benefiting from Hugh's insights into the financial industry for many years, so it's great to have a chance to quiz him about this topic and for him to share his views with all of you. Hugh Van Steenis, welcome to The Big View.
Thanks for having me, Peter.
So, Hugh, as you know, Breaking Views, we like to focus on numbers. And with topics like this, I always think it's helpful to give people a sense of the big picture, just the scale of what we're talking about. So when we talk about private credit, how much money are we talking about?
Oh, it's a great question. And I think it depends what the definitions of private credit are. So if I take the seven largest private market firms who are listed on the stock market in the States, between them, they've got 2.1 trillion of credit assets, which is both, corporate lending, but that also includes a little bit of real estate and infrastructure lending. Now that's just seven firms. So on the back of our envelope, you get to well over 2.75 trillion. The official stats from Preqin, which is the firm that BlackRock bought, place the industry near a 1.5, 1.6, but they don't include insurance money. And as we'll come on, no doubt, to talk about, actually, they're the unsung heroes of the private credit growth in the last few years have actually been insurers.
So that's a lot, and it's obviously grown very quickly. But just put that into context for us. So, like, if you were to compare that to, I don't know, bank lending or something like that, just sort of what kind of a slice of the sort of overall credit pie are we talking about?
So there's about 9 trillion, let's take US numbers, there's about 9 trillion of investment grade bonds in the States. So it's just under a third of that. The high yield market is of a comparable size, the US high yield bond market. And then obviously, depending on whether we're talking that number, the 2.1 trillion plus or 2.3 trillion plus is obviously a global number. And that compares to, well over 20 trillion of bank assets. So it's a growing and important chunk. But I think one of the things that I was really struck by, and I think has really changed the debate in the industry, is after the Fed put up interest rates, in that sort of period where we had the biggest interest rate shock for 45 years, to be honest, bank lending seized up a bit because of the way the bank regulations now work, and private credit continued to lend. And so actually, for a period of time, it was actually a very meaningful source of mid-market loan growth.
So let's talk a bit about the evolution, because I think obviously if we'd rewound the clock to, before 2008, these numbers would have been tiny. And so So there are sort of phases, right? There's a sort of post 2008 phase when basically private credit is lending to sort of mid-market borrowers who are finding it harder to get credit from banks. That's basically right?
Yeah, no. So look, I think you and I share the view that sort of finance comes in waves. So from the financial crisis to, let's say, to the pandemic, $1 trillion parallel credit system was formed in the States, primarily to lend to mid-market companies and to finance acquisitions, particularly for financial sponsors. And that $1 trillion, in a way, was the explicit, ask of what bank regulators were doing. Part of trying to sort of prop up the banking system and to ensure that never again taxpayers' money was put to support it. They had to increase their equity. They had to change their ratios. And so in some ways, bank regulations were explicitly pushing out assets. And that was one of the key opportunities and tailwinds for private credit in that period. Now, I think there's another wave coming now, but certainly that sort of, 14, 15-year period, I think was really a very powerful source of tailwinds.
Yeah, and then as you talked about, you mentioned there was that period in sort of, we all remember in 2020, 21 when COVID came along and the banks were also slightly frozen up, and then the private credit stepped in and funded a load of sort of big leverage loans and things like that, which they hadn't done before. But then talk about this new phase then, because you mentioned the wave earlier. I mean, part of the question, waves tend to crash at some point, right? So at what point do we think this comes back down, or do you sort of see it continuing to grow a lot?
Well, look, it's a great question. Look, I always think that I agree with my good friend Neil Ferguson that most economics majors should do a bit more history and a bit less math. And so, if you think about the disintermediation, let's take U.S. banks. Actually, the peak of bank lending to the economy was actually 1973, and we've had wave after wave after wave of disintermediation. But as you say, also some reintermediation at times, particularly into the financial crisis. So what we're seeing today in terms of disintermediation is powerful, but it's nothing compared to what we saw in the 70s and 80s. So point one, let's keep in context. It's an important source of growth, but we've got a much more variegated and diversified system now. But I think in the last 3 years, the area, Peter, that I think that is really interesting is the role of insurers. So if I go back to the top 7 players, just because we've done the work on this, insurers funded 32% of their assets back in 2021. Today, it's over 43%. Or put another way, more than half of all the fresh money that's come into private credit over the last 3 years has come from insurers. And of course, what an insurer wants is lower risk, higher quality, long duration loans, data centers, energy infrastructure, and the like, which is very different from going to Yale or Stanford and selling to a bunch of endowments a higher risk credit portfolio for cuspy investment grade or non-investment grade companies. So it's also changing the complexion of how they can lend, but also the kind of the business models they run too.
Yeah, and that nexus with insurance is really fascinating. I mean, obviously, some of these firms, Apollo, KKR, have their own insurance arms, right? So to a certain extent, they're sort of sourcing the money that's going in that then goes into the funds. But it's broader than that, basically, is what you were saying. Other insurance companies are also channeling money into private credit.
Oh, absolutely. And look, I don't want to get into particular names this morning, but no, if you know, every single, all of the larger, so I think you had Mark from Blue Owl on before Christmas, and he talked about, above 40 billion, you're sort of in the game, but between 10 and 40 billion, you're in this kind of no man's land where you're too big to just be an investor, but you're probably a bit too small to really compete with these juggernauts who are now in some cases, over $500 billion of credit assets. So if I think about the large firms, all of them have now got insurance partnerships. In fact, they've got multiple insurance partnerships. And also, as I engage with the chief investment officers of the insurers, they also want to have multiple relationships. I mean, just in the same way you wouldn't put all your money with one bank or with one fund manager, they're also looking to diversify their own sources of risk and diversify. So no, I think one FIG banker was telling me that in January alone, he had orchestrated 14 meetings between insurers and private credit firms. I mean, this is an area of huge focus. And of course, if the leading firms are tuning up their investment engines with private credit and getting slightly better returns for their clients, then there's almost a competition that everyone who's not doing that needs to catch up. So there's a lot of focus on adding to the portfolios.
But what's shifted here for the insurers? I mean, has there been some sort of, is it a change? Is it returns? Is it regulation? What is it that's kind of prompted this reallocation?
Look, I always think in finance, we've chatted about this before, Peter, that you normally need 2 or 3 things coinciding to get a big wave, because one thing alone only gets you a small wave. So first was, of course, 15 years of zero interest rates. And so if you were trying to buy an annuity and you were just living off US government bonds, well, gosh, that's not an exciting retirement set of income, was it? So by putting maybe going 15% of the annuity portfolio into private credit, the aspiration is that for a single A bond, so an investment grade borrower, you could maybe make 1.5% to 2% more returns than the public bond. Well, that obviously you can work through the maths of that, sort of tunes up the investment return. So that's clearly one. I think 2 is that the insurers, have got an obligation to look after their policyholders. So they also want to improve returns. And so they are actively looking for better investment returns. But also there's an element of regulation here. And as, of course, as bank regulations and finance regulations have changed, that's also nudged more of these assets to come free.
And so, and the argument for insurers is essentially they are looking for, particularly if they're selling annuities and stuff. These are long dated liabilities for insurers. So therefore, they can go out and buy long dated assets that might not be very liquid, but will offer them a better return over time. That am I simplifying?
Absolutely. So look. So let's if you and I are sitting down with a CIO today, what they'd say is, look, we want to make 7 to 9% in our credit portfolio. We want we're investing our clients' money for a decade, so we want assets which are quite long, and also we need them to be high quality. Not just because we don't want them to go bust over the following 10 years, but also the way the regulations work. You also need to, this disproportionately favors investing in investment grade bonds. So there's a huge interest in tuning up those returns. And in a way, Peter, going back to history, this is in some ways going back to the model of insurers, post the Second World War. If we go from sort of 45 through to probably 65, insurers were the major providers of infrastructure finance in the States, whether that be utilities or other transformations. And in fact, in some cases, the insurers wholly owned the utilities, the infrastructure. Obviously, financial innovation changed that, but in a way, we're going back through a kind of a modern version of an old trend.
Right, and the benign view of this is that this is a better system, right? That actually, if you get banks to fund this stuff, banks are funded with short-term, deposits and other kind of sources of funding that are kind of vulnerable to shocks and runs and so forth, and then you get a sort of crisis because they've got all these assets and they can't liquidate them quickly. So actually, this is a safer way of organizing your financial system, is to have long-dated assets and long-dated liabilities sort of matched like this.
Look, so I think this is one of those questions where there's an easy answer and a complex answer, and I think we should do the latter, but we have time for the former. I think there is real strength through diversity of funding. I think it's important that for a given risk, we should give longer dated risks to those people who can fund them. And if you've got the choice between whether you're funding a long dated loan through a bank or through an unlevered or a less levered insurance company or investor, on the whole, having someone who can hold it for overnight deposits versus long duration funds, well, it's pretty clear that's a better model. That said, of course, there is real complexity around. You need to make sure that money is there today, tomorrow, and the day after. That it's well locked up, that it's being sold to suitable. It's also being owned by suitable providers of that capital. And so, like any sort of financial ecosystem, the devil is in the detail. But I do think having more long dated loans held by the best people who can sit with them makes a lot of sense.
So let's talk about some of the vulnerabilities. We're always kind of like trying to sniff out where the unexploded landmines are. And it sort of seems to be like there's a couple of different aspects of this that people worry about. And one is just that when you have a new set of lenders coming into the market really quite quickly and ramping up quite fast, that they're making loans on terms that other people wouldn't make, and those loans will go bad at some point. This hasn't been through an economic cycle yet, and kind of just wait and see. This will end in tears. I mean, how do you sort of think about that concern or that criticism?
So I think, look, it's a very valid concern. Look, we know the history of credit cycles is that over enthusiasm can lead to bad decisions. So I fully take that there will be some good decisions and some bad decisions, and so the answer here is not just so much at a system level, but also at a manager level or a vintage level. Did that vintage work out well given the risks that they're in? I think second, I think we need to kind of segment the market a bit. So, for instance, if you're a private credit player lending to a company who wants, I don't know, $50 million, the banks don't really serve that market. The mid-market banks are still on their back foot a bit after the shock of 2 years ago. As long as you've chosen a good underlying credit, or you've lent to a good borrower, you should be able to navigate that well. But I think the kind of the underlying thesis would be the larger private credit becomes, the more it will tend towards the average experience that banks have had. And so I think it's been relatively straightforward with the tailwind of very low rates and the banks not being the market, that there were good terms available and that private credit could, quote, cherry pick to some extent. But now with interest rates being up, and it's taken a while for the higher interest rates to work through the system for all the reasons you've debated on previous pods. But I do think there are clearly, there is a tail of bad credit in the system. But, is this worse than the banks? Well, only 2 years ago, you were talking about all the silly real estate loans the mid-market US banks were creating. So I think we need to be careful here, think about, are the decision, not that are there no bad decisions, but when you look at the overall fact pattern, what's the, two things is do people get what they expected? And then second, what are the repercussions? Well, if you're sitting with a bank which was 10 times levered versus maybe a fund manager who maybe has got 1 times leverage on it, even if things go wrong, there's just a lot less spillovers that can happen. So, again, eyes wide open, but I think the overall system for the moment does look like it's got good integrity.
Yeah. I mean, is it too early to say what the sort of the credit quality, how that's playing out, or do we actually sort of, do we have some numbers that mean we can sort of come to an assessment and say, well, it's no worse than what's happening in the banks or something like that?
So if you like, I can answer the historic question. The more interesting question is what's happening now, what will happen. On historic, there was the Fed did a study about a year ago comparing bank syndicated loans, broadly syndicated loans by banks versus private credit. And what they showed is that the loss experience thus far has been well below the banks. But if you dissect it, what I thought was interesting in that the Fed study was that the probability of default, so the risk that someone trips over, was lower for the private credit firms, but the loss given default, so if you trip over, how bloody a nose you get, was far worse, because obviously these companies were probably more leveraged and had fewer assets available. So experience historically has been better, but we have been through a very, very benign period. But I think going forward, I think this is like most things in credit. We have to talk about the subsector. Where are the shocks? I mean, obviously, as we both know, some of the energy companies got hit very hard during the Ukrainian crisis. During the pandemic, a lot of hotels and leisure businesses got hit very hard. It depends on the kind of the economic shock we get. But the more cyclical the business, the more there is a little bit of stress in the system. But if you look on your tape today, credit spreads are incredibly tight, which speaks to the fact that on the whole, not just there are more buyers than sellers, but on the whole, the credit conditions remain pretty benign.
What about the other thing you hear from bankers is that they say, well, when things go wrong, we as banks we can be more flexible, right? We can sort of say, oh, well, that covenant that you agreed to, we understand that you're going through a little rough patch, but we think you're going to be okay. We'll waive it for a bit, or we'll sort of, we'll ignore this for 12 months and give you a bit of time, give you a bit of flexibility to sort of get on your feet. And again, the bankers say this, talk in their own book, obviously, say, well, the private credit firms can't do this because they're operating in funds and they have quite tight fiduciary responsibilities to their investors, and therefore they don't have the flexibility to do what the banks do. How do you think about that? Is there any evidence that that's the case?
Gosh, it's a good question, but again, Peter, I think it comes down to the devil in the detail. So look, I think the easy point to make is when you've gone from one lead borrower to maybe one where there's sort of 10 different parties involved, it can get very legal very quickly, and you can get get into some trouble. But as a sort of somewhat a 20-year banks analyst, let's be clear: the way that banks are regulated today, it's not so easy that they can just provide forbearance to loans and close their eyes and hold their noses and it not be reflected in their accounts either. So I think the way that the modern financial system works is much more complicated and much more nuanced than maybe the textbooks of how banks and investors work. And I think that's one of the challenges here, is that the system has become ever so much more complex. One thing which I'm really struck by is, there's been let's broaden this just beyond people going bust. There's clearly been a bit of indigestion in the private equity system because in the euphoria of or into the pandemic and so forth, there was a lot of endowments went very, very overweight venture capital and private equity, and with 2020 hindsight, they probably got a little bit too more illiquids. And with the IPO market being closed more or less for 3 years, or at least being modest, they haven't provided those exits. So there's a bit of ingestion. We've seen tremendous innovation in the last 2 years and a half, whether it's evergreen funds, continuation funds, sidecars to let people get some liquidity out, secondary vehicles, or obviously on the credit side, PIK and some other areas. Now, I'm not trying to say that every single innovation is perfect, but what's been fascinating is if the banks say they provide forbearance, the private market system sees a problem and is innovating to try to solve it. Imperfect, and I'm sure we'll have some challenges, but I think it's too simplistic to say banks good, investors bad. And I think that's one of the mistakes that when I engage with governors of central banks, they sometimes have a little bit too, a model of banks which is still too over-indexed to 2008 for all sorts, because of the trauma and scarring of that. And I think they underestimate actually the vibrancy of having a system which is much more investor-led.
Yeah, and it definitely sort of that kind of simple model of banks and funds also doesn't really take into account the way that banks arrange these loans, right? Which is sort of, were you talking about broadly syndicated loans earlier? That's the bank is kind of putting it together, but then distributing it to lots of different people, including not just other banks, but collateralized loan obligations and so forth. So you kind of have this dispersed system anyway.
Oh, completely. And look, when we were chatting about a month ago at Davos, we also chatted about how the banks are back. If the Basel rules are now going to be maybe not kicked into touch, but much more moderate. I think the in word is that they're going to be capital neutral. So there's going to be some tweaks to the valves, but overall there's going to be no net increase in capital. Well, in that case, the top 12 US banks probably have about 90 billion of surplus capital. They want to put that to work. Not all of it's going to come back in dividends and buybacks. Some of it's going to be reinvested in the business. And so as the banks are back, one of the most interesting conversations I'm having with leaders is, how do the banks make sure they keep a slice of the action in the private credit world? Is it through themselves seeding private credit funds in their fund management divisions, or is it creating capital solutions groups in the investment banks? So whatever the borrower wants, whether they want a private credit loan, whether they want a bank loan, whether they want some bank facilities, but the borrowing come from somewhere else, but they provide some facilities. They want to make sure that they keep a slice of the action. And so I think we're also seeing some very interesting innovation from the banks, who are trying to keep as relevant as possible, particularly when they've got a little bit more cash up their sleeves.
Yeah, I just want to park that banks point, because I think that's very important. We should come back to that in a bit. But just sticking with the sort of with the private credit lending. I think one of the questions here is obviously how much bigger can this get? And so when you listen to some of the sort of the the kingpins of the private credit world talk. They've got these vast ideas of sort of the vast swathes of kind of credit that could be moved into private credit type structures. And then you also have obviously, very large projections for sort of lending for things like data centers. So, kind of, I was talking to one of the big sort of alternative asset managers the other day, who was just saying, there's a vast amounts of demand for financing for data centers, which is difficult for the banks to do because it's sort of asset backed and it's long term and it's not very attractive for them. And so this is going to have to be done probably through private credit. So I get when you think about how much bigger this gets, how do you put the various? Is it sort of shifting existing lending out of the banking system or other areas into private credit, or is it also just whole new categories of financing that are being sort of used?
My take is that private credit's next act is around asset-backed lending. So exactly, Peter, data centers, energy, but also quirkier stuff like litigation finance or credit card receivables. And the reason for that is that it suits well the demands of their insurance clients. Now we'll come that it's also greener pasture. So we analyzed the sort of specialty finance asset-backed lending market last year. In the States, we thought it's roughly a $5.5 trillion category, where banks control 2/3, but actually non-bank financials do about 1/3. But within that, private credit was probably only 5 to 6% of the $5.5 trillion. And so, could we see private credit growing to 10 to 15 to 25% of that specialty finance market? Absolutely. And, again, if we go to history, GE Capital used to be a major player in non-bank, in this sort of asset-backed lending. Unfortunately, they did it with overnight deposits and they just did it with a funding model, which is not as good as some of the players which are doing it today. So if you look at then what the major US firms who are listed have committed to the market, they're all kind of hoping to double over the next 5 years. So 15% compound growth. Again, does that sound excessive? Given in the context of the specialty finance market we just discussed? Not unrealistic. What are the challenges? Well, one is this going to be all organic, or are they trying to steal it from someone else? And I think one of the interesting stories here is they're not just trying to win share from the banks, but also from non-banks, and quite frankly, from getting some of the securitization investment grade market to go from being public to private. So actually, they're trying to be ingenious and picking from different parts of the system. So I think it's definitely plausible. What could go wrong? Well, clearly, credit is always a geared play on the economy. So it depends on whether we fall into recession and when we obviously got a growth shock. Two, are there enough assets to go around? I mean, at the moment, there's still, even with DeepSeek, still enough euphoria. There's going to be a lot more data centers built, but let's see how this plays out over time. I mean, numbers of $1 trillion more of data centers the next 5 years is the kind of base case for the US market at the moment. But I think, as we discussed earlier, the leveraged lending market is not really picking up. I mean, when I looked at and I analyzed this ahead of this pod, M&A by private equity firm sponsors is down about 35 to 40% on the 15-year average because of the indigestion in the system. And so actually the leveraged loan market is quite heavily bid because the banks are back, everyone's trying to feed, and there's too many mouths to feed. So they do need this fresh territory, otherwise there will be some choking of the growth.
So come back to the banks then. I mean, you mentioned earlier on these waves of disintermediation going back to the 1970s, and we haven't been following this for quite that long, but I mean, we've also discussed over the years sort of some periods of disintermediation, but also then re-intermediation. You talk, where the banks sort of insert themselves back into the system. So, what does that look like for banks in terms of their business model at the moment? I mean, to what extent are they worried about what they're losing? To what extent can they make up for it elsewhere? So how do they adapt to this?
So I think there are a number of big calls here. So first is if you look at the banks, the ones which have got more fee income are more highly valued. because investors have been conditioned that, banking is cyclical, and particularly for the last 15, 17 years, we've had either negative or zero interest rates, which has been parlous for the net interest income, the core business for a bank. And so fee income has been everything. And obviously you can see that through the re-rating of Morgan Stanley and others, and everyone's chasing that. So I think that's good news. But what if the last 15, 17 years is just the historical anomaly of the last 300 years? And just actually interest rates do remain that little bit higher. To be honest, net interest income could just go back to being quite interesting. And I certainly think, I know that's not where the market is today, but to be honest, that's sort of where I am. I think the banks actually have got more tailwinds from the interest rate environment than the market is currently anticipating. But clearly that's a macro view. I think second, though, bank regulation, is the pendulum swinging back, or at least is there some recalibration? And, I think that the Basel Endgame, I think we can all say, asking for 19% more capital for the big banks was
in the US.
Had no basis in fact whatsoever. And in fact, the regional banking shock showed very well the top 12 banks were in really, really, really good shape. And it was the regional banks who weren't. So I think that model has proven, and that's why the Basel Endgame, I think the market and I are probably in alignment here, is like, it's going to be neutral. I think the Europeans are still trying to squeeze the banks a bit more, but it'll be interesting to see with a little bit of international competition whether even they accept that actually the large cap banks are now well calibrated. And I think that's something which increasingly will come through. But if you think about the bank's business model, the challenge is the way the rules are written. You're not paid to hold on to loans for a very long period of time. So the bank regulations are explicitly to try and encourage you to externalize more of those loans. And I think that in a way is plays to the benefit of the investment banks, but maybe challenges some of the regional banks. And that's why we've also seen so many partnerships between banks and private credit firms, where the banks are originating private credit, trying to be the storage sites for these loans. We all know through the history of JVs, many JVs fail. But at least I think for the moment, we are watching with huge interest how these partnerships play out.
Okay, so one historical analogy that might be relevant here, that line about banks saying, "Oh, we're not in the storage business, we're in the moving business." I've heard it pop up again recently. The last time I heard this was in sort of 2006. When they used to talk about this in the context of mortgage-backed securitizations and CDOs and all those kind of things. And of course, it was wrong, right? Because what was actually happening was the banks were parceling up these loans, they were shipping them out as securities, and then they were essentially buying them back in a different form and putting them on their balance sheets. So the balance sheets grew and grew, and then with predictable end results in 2008. I mean, is that something we should be worrying about here? That there's some sort of similar kind of process going on?
So let me frame it in two ways. The first is what you put your finger on is that it's the origination of good assets or good risk-adjusted credit assets is the gate on the private credit industry. It's not fundraising, it's about origination. And for many firms, they'll want to originate themselves. And so look, the reason why some of these firms have now got lots of people, thousands of people doing origination of mid-market loans, or were quite happy doing leverage buyout loans because they could talk to 30 people and get a good sense of the assets, is the more you move into this fresh territory, you need a different set of skills. So for instance, many of these asset-backed loans then require an understanding of, if it's large ticket, you need to understand the data centers. But if it's statistical, so it's trade finance inventory or receivables from credit cards, that's a statistical pool analysis, which is not the skill set when you're just looking at 29 loans in a portfolio. So the credit skills of the managers need to be upgraded. A lot of them are doing it direct, but I think you put your finger then, Peter, on the second key bit, is that in these partnerships, the make or break will be how to align incentives. So what the bank originates is what is on the tin of what the credit or the insurer in turn wants to buy. How to ensure it's high credit quality? How do you turn down loans if you've got a partnership? How do you ensure the credit grid is being authentically lived day in, day out? And that's where, some of these partnerships, certainly from my conversations, are still trying to iron through these wrinkles, because alignment of interest, as you've shown through history, is tricky. And so probably some of this will be changes in, there'll be a lot more, verification or two steps and so forth. So I think I think the problem you identify is a real one. I think the key issue is then trying to find, belt and braces to try and address it.
Yeah, and I guess this is also why the regulators seem to be mostly focused on the linkages between the banking system and sort of private credit, right? To what extent there are sort of things there that could rebound on the banks and then cause them to sort of get into trouble.
I think that's right. Well, look, I think regulators are paid to worry, and there's lots of things they're looking at. That, my overall thesis is that private credit is almost like a retranching of the banking system, where the riskiest pieces of risk are parceled out to investors, and banks then in turn finance the lower risk pieces. So you're slicing up the cake in a different way. And so in many cases, private credit firms are having funding provided by the banks, but the first loss piece they or their investors will shoulder. So is that a higher risk system or a lower risk system? I think you would argue that's a lower risk system, but then you need to think about concentration risk, conduct risk. Has it been done well? I think the question, which, in fact, the Bank of England's done a good amount of work on recently, and I think other regulators have been watching, is are there other sources of hidden leverage? Because if we go back, both of us sitting in the UK today, whether it be through the trust wobble or whether it's through Archegos and what happened to Credit Suisse, it was kind of, quote, hidden leverage, which really tripped people up. So to also understand, even if we've argued that the underlying funds in private credit are not that highly levered, got low turns of leverage, are there other sources of leverage in the system which could chaotically amplify? And I think the study they found so far was somewhat neutral so far. But I think getting the tools to, probably getting a bit better data and understanding credit creation and the linkages will be important.
Yeah, no, especially as it continues to grow. Hugh, we have to leave it there, but that was really fascinating. Thank you very much for coming on, and I'm sure we will be debating this for many months and years to come.
Peter, thanks for having me on.
That's it for this week's show. Many thanks to Hugh for all those insights. This podcast was produced by Oliver Tasich in London. You can listen to a new episode of The Big View every Tuesday on the Reuters app or your favourite platform. Don't forget to tune in to our sister podcast Viewsroom every Thursday, as well as the other great podcasts from the Reuters team. If you liked what you heard, please follow The Big View and let us know what you think. And check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.